Thank you. So, good afternoon, everybody. My name is Alvin, and I'm your moderator for today. So, so before we start, right, I would like to get everyone here to actually bring up your phone, scan the QR code, and we'll pull out a Slido question to get a poll for everyone to vote. So, wait, Yep. Yeah. So you can see the poll on the screen now, which says which asset class do you think will likely to perform in 2026? And at the meantime, right, because today. Together with me, we have the experts in the industry, so which you don't get it every day. So I would like you to ask any questions in the chat in the Q&A box, and we will address it accordingly. You can throw in very interesting, very grilling, or very funny questions as well. We will selectively address it accordingly. So before we let the poll run it for a while, right? We will start with one rather casual question, whereby you see, since the start of the year, right, just 10 days entering into 2026, we have seen US just randomly can go enter into a random country and then just catch their president. So how do you think geopolitical tensions will shape global equities in a global economy in 2026? Can I get Mr. Lu to answer this question first?
Yeah, thanks for the question, Alvin. I think in terms of geopolitical risk, this is one thing that will stay with us going to 2026. But like the incident that happened in Venezuela, I think we are living in interesting times. Nobody would have foreseen this happening. But I think market-wise, what is the impact to market? I think in the last few days, the market didn't really react that negatively to this development. So I think on and off, when this thing happens, they might be a short-term blip, 1 or 2 days kind of correction. As long as, say, touch wood doesn't blow up into a full-blown war, I think market will just brush it off and look at the fundamentals of companies, sectors, industries, and just oversee this kind of volatility.
Yeah, so I saw one particular question which is quite interesting. They say, whether do you expect China will do the same thing to Taiwan?
Yes, I think that's one of the hot question that comes up. First, I mean, this is my personal view. I don't think that will happen in terms of China invading Taiwan. But on and off, China, what they'll do is they can't sit quietly and don't react to all this criticism or anything. On and off, you'll see them trying to flex their muscle, having some drills close to the Taiwanese shore, but I don't think it will expand into a full-blown invasion of Taiwan.
So less likely. Okay, so what will this geopolitical tensions shape Malaysian economy? May I give this question to Mr. Christopher?
So is it Malaysian economy? Is it?
Yeah.
Yep. So I think, like mentioned, there may be geopolitical flashpoints across the world, but I think the key one that affects us here is the relationship between US and China. And I think what's positive is that there's been a pause in the tariff wars. I think for now, in the short term, we can see a sort of a pause because that I think the Chinese have discovered that the US has one vulnerability, which is their need for rare earth materials. So we saw that when China actually pulled the rare earth card, the US start to hesitate and start to give in to the negotiations. So we know that in the next 1 to 2 years, while the US is still scrambling to get their rare earth production up and to start to develop their refining capability, we know that the trade wars will not escalate too much because the US still needs all these rare earths from China. And likewise, the Chinese also needs the US consumer market. So there may be tensions that erupt on and off, but at least for the short term, and even this year, I think there is a proposed meeting between Trump and President Xi Jinping. I think probably in either April or May, and that will probably ease tensions. But I think you could see, weeks where there could be some news and some noise, and then that might affect the market. And I think for us in Malaysia, we are neutral. We're in the middle. We trade with both US and China. So I think as long as the trade wars don't erupt into a full-blown crisis, I think we'll still be okay by selling to both sides.
So Malaysia can navigate it quite smoothly.
Yeah, we think so for now.
Okay. So yeah, so how do you think all these geopolitical tensions will affect income strategies? May I pass this question to Mr. David?
Yeah, thank you for the question. The beauty about income investing is that, because you're already quite diversified from your income sources, asset classes. So typically speaking, from our experience, every time there's a huge shock from the market, whether it's geopolitical, whether it's something that Trump tweeted overnight, we have seen income strategy quite resilient. I think just now in one of my earlier slides, in 2022 event, when interest rate was increased drastically in the United States, we have seen the drawdown of typically multi-asset income of anything, a single digit actually, 5, 6, 7%, thereabout, across our portfolios that we manage for our global investors. You compare that to a pure equity, S&P 500 dropped about close to 19% in that year. NASDAQ, you're talking about 30% to 40%. Global bond that year dropped about 13%. So to me, I think the key thing is when you are already diversified, and then not to mention, you have to implement the next stage, right? Remember the flexibility. So when market cycle move, interest rate move, you have to move as well. So when interest rate increase 22-23, year 22-23, you allocate to fixed income. Yields are compelling even until today. And not to mention, one also have to be diversified across equities. I just want to mention about equities, yeah. Not sure if ladies and gentlemen are aware, in S&P 500, do you know that the top 10 stocks constitute 40% of the returns? Or the weight, my apologies. 10%, 10 stocks in S&P 500 constitute 40% of the market. So it's like football, Football, 10 players contribute 40% of the goal that score, 40%. So if 2 players from the 10 players are injured, do you think they can still score more goals?
Less likely.
That's the thing. So my only worry is that from observation, now it become portfolio risk. Granted, the top 10 stocks are good companies, but if something were to happen to these top 10 stocks, just because they're very influential, that's my worry for my investors. So I really urge all of you to be diversified. And I feel answering your question, income investing will help in the event of certain shocks in the market. Hopefully that answered the
Yeah,
question.
definitely. So thank you. So I'll continue this question with how, as an equity investors, how do we navigate this better? Can I pass this to Mr. Jeremy?
So when I think about navigating markets and being prudent in allocating capital, I think your point on diversification is really important. But I also think you have to, build into your portfolio different styles of return. And so owning technology and AI is very much a highly concentrated beta trade. And so, our view is that how can you identify companies that really, irrespective of what happens in the broader environment, will continue to grow their earnings, continue to drive their shareholder value. And, when we look across sectors, there is a wide range of opportunities. And like, for example, think about healthcare. We all have to go to the hospital. We all are having children, having accidents, having surgeries, whether it's elective or necessity. And so there's certain companies out there that, irrespective of what happens in geopolitics, in inflation, in the business cycle, will still be a core part, critical to society and municipalities. And so those types of businesses, if you can find the right ones that are managed by phenomenal management teams can create incremental value. And if you look in the US today, there's a large hospital operator that has grown their earnings 40% year on year. This is a phenomenal business that really is core to the US economy and to the necessity of society. And I think if you're building a prudent portfolio, it's really thinking about uncorrelated returns, ones where there's resiliency and consistency in the earnings of those businesses, but they're operated by individuals that really can create and compound shareholder value over time.
So the key is to pick business that has low beta and resilient business model to navigate all those uncertainties. So before we really go deeper into it, we have quite an interesting question here, whereby I'm not sure does anyone know, right? Whereby the European markets, as measured by the stocks 600, is already trading at all-time high levels. And European market has always been that sleeping giant that not much people know about it. So for this question, right, can I get Mr. Lu to answer, whereby can you share us what was the reason that European market has not been in a lot of investors' radar, and why should investors have European in their portfolio?
Okay, sure. As I mentioned in my previous session earlier, European has been dragged by a tight monetary policy previously. And in terms of fiscal spending, they have also been rather conservative. But things have changed. They have moved on from the Ukraine-Russia conflict. And right now, we are starting to see Germany leading the continent with pushing on infrastructure spending, and also in terms of the digitalization effort across the continent. This is something they have to do to awaken the whole continent rather than leaving it in the slum. So I think going forward, we have seen meaningful actions from the governments over there, especially Germany. So I think this is not a one-off thing, but kind of multi-year investment cycle that will help to support the equities market in the coming years.
Okay, so may I get Mr. Jeremy, because I realized that one of your fund is actually quite overweight in Europe, which is actually in contrast with a lot of global peers in the market. So may I ask you, how do you think Europe is attractive when it comes to comparing to US?
Yeah, it's a great question, and I think we have a similar view to the structural reforms, everything that's happening. But we're very much bottom-up investors, and we look for companies again that have low economic sensitivity and very consistent earnings. And in Europe, you're finding companies where you don't have to pay a significant premium for growth. And so there's companies that specialize in energy. And if you think about Europe right now, the fiscal reform, the capital investment is heavily in infrastructure. You saw on the screen earlier, $500 billion is being invested to ensure energy security, the rebuilding and refreshment of infrastructure. And clean energy is at the epicenter of that. So companies like Engie, for example, are building out, last year they did 5 gigawatts of extra power. They are at the epicenter of secular change and are one of the leading operators in France and are all across continental Europe. And so, finding individual businesses is exciting and phenomenal. But if I take a top-down look, and more similar to my colleague on the panel, if you think about Europe today, you have 2 engines that are working in parallel with each other, where in other parts of the world, potentially the fiscal and monetary engine are working in contrarian with each other. So when I think about sort of the fiscal spending, you're having a refocus on domestic, on economic resilience, but you also have a moderation in monetary policy. Interest rates have come down modestly, and the inflation shock is more in control in the European Union. And so I think both of those factors, plus growing profitability in Europe, across continental Europe, really creates a very interesting starting point for identifying companies. And people often think about Europe and they think about Hermes handbags and luxury goods. But this is an area actually where we're seeing innovation, whether that's in the industrial space in manufacturing or in places like healthcare and biotechnology.
So can I conclude that current macro backdrops are very supportive, and then which makes a lot of those resilient business, good business that are mispriced previously more attractive in Europe?
Most definitely. You've
Yeah.
got a macro backdrop where fiscal and monetary are on your side, and you have a level of growing earnings. And the final kicker is valuations are cheaper relative to the US. So it's kind of like the trifecta for allocating capital.
Thanks. So now we move on to Malaysia, which has quite a lot of questions also, because everyone has been asked, a lot of people has been asking actually that after a quite lackluster performance in 2025, comparing to a lot of the global peers, can we finally expect a better year in 2026?
Yeah, I think last year Malaysia was a bit of a laggard in the sense that the market was flat when the rest of the world was up. But I think if we look back one more year, I think in 2024, Malaysia was a standout performer. I think the FBM 100 was up, I think, high teens, and a lot of our funds were actually up more than 20% in 2024. So I think last year was a bit of a digestion year, given the previous year's strong performance. And I think there are a lot of reasons to be positive on Malaysia into 2026. I think we are still on the investment upcycle. A lot of companies are actually bringing back money to Malaysia and are starting to reinvest. I think the data center construction really kicked things off. But as that's also spawned a whole ecosystem of suppliers, of contractors, of engineering support services that will benefit from this whole data center infrastructure development. We're also seeing the government getting more proactive, right, in terms of the infrastructure and construction projects. I think building towards the general election next year. So we see a lot of awards of railways, of infrastructure, of highways in Penang and also in East Malaysia. So we really are in the midst of a infrastructure and construction upcycle. I think the market last year was a function of valuations that maybe got a bit too high in 2024, so needed some time to digest. But we'll start to see more opportunities this year. I think for Malaysia, we are in an environment where, things are finally looking up after a long period of, so-so growth. I think in the last 10 years, I think Malaysia has been through a lot. We've been through the whole 1MDB scandal where a lot of foreign investors exited the country. I think the key index didn't really move much in the last 10 years. But in the last 2 to 3 years, I think we start to see things shaping up in terms of the growth drivers. And I think that a lot of investors are also starting to have a bit more confidence to invest here after a long time, even as evidenced by the strong ringgit, which was up 10% last year. So I think there are a lot of things to be positive about in Malaysia, although, as Malaysians, we only see the issues and tend to complain a lot about politics and here and there. But actually, you look closely on the ground, there are improvements. And, there are plenty of places to invest in Malaysia. I think the small caps also, although last year wasn't good, but this year we do see more opportunities there as well.
Thank you. So I see one very sharp question here as well, because last year foreign investors hasn't been very friendly to Malaysia, and we have always heard people saying, "Oh, they will come back, they will come back." So will they really come back in year 2026?
Yeah, so I think foreign investors, if you look at it, they came into the Malaysian bond market actually, but they have actually exited the equity market. So I think that's just a function of the relative attractiveness of markets. I think fortunately or unfortunately, we live in a more globalized world where capital, is free to flow anywhere in the world. So I think last year there were plenty of good opportunities in terms of the AI space, a lot of excitement in the US, in Korea, and Taiwan. In China also, they saw a rebound, after many years of property down cycle. So I think it was just a factor that there were more interesting places to invest in for foreign investors last year. But after a really very strong performance for the North Asia markets and also US, I think if things, start to moderate a bit, foreign investors could relook in Malaysia. Like I mentioned just now, actually, there are plenty of drivers to be positive for Malaysia. But I think maybe it's just that the relative attractiveness, they need to study that before coming back. And if you look at the foreign shareholding level, it has really reached probably all-time low of about 19%. So what's from a glass half full point of view, is that they have probably, done the bulk of the selling, and any incremental movements should be positive. We also see, the local big investors like EPF, the pension funds, PNB, start to bring back money from overseas back to Malaysia. So that also creates a positive fund flow effect for our stock market as well.
Yeah, so thank you. So since we have heard about the perspective of our Malaysian fund manager here, so I have a question for Mr. David here. Whereas from a global fund asset management perspective, how do you see Malaysian equities?
From our perspective, as a global investor, we are the view that Malaysia has been, I think we put it as a low-hanging fruit. I think a lot of, relative to Malaysia, a lot of other countries have been getting a lot of inflow in the last few years. And we started to see that change in terms of the last 6 months to 12 months, in terms of perception about Malaysia. Talking to my colleagues from all the way from London, US to Hong Kong and Singapore, every time I ask about how they view Malaysia, the tone changed. Simply because, one, if you look at relative to ASEAN, we actually do look better now in terms of prospects, and ringgit is the best Asia performing currency in 2025. And not to mention in terms of politically speaking, we are now more stable than our neighbors in the region. Thailand, as you know, they have their own issues. Cambodia, Indonesia have a bit of tricky part because the new president are implementing policies that foreign investors don't quite like. Philippines also have their own issues. Yeah, so certainly I would say Malaysia stand differently right now in a more positive way in the eyes of our international team.
Yeah, thank you. So you can see you heard from our local fund manager, heard from the global asset management house. So definitely, I think what I see here is signs that Malaysian equities definitely had a chance in 2026. Okay, so moving on, I have a follow-up question for Mr. Luo here, whereby besides Europe, right, do you see any regions, countries that you find attractive?
Okay, besides Europe, we also like the Asia Pac market side as well as the emerging market. I think with the US dollar is expected to continue on its weakening trend. Expect more flows to flow into the non-US market, so Europe, Asia Pac, emerging market. Within ASEAN as well, I think David has summed it up very nicely. Malaysia itself, I think we can't ignore it. We are standing in a sweet spot right now. What we are experiencing right now in terms of the political stability, it takes years for us to reach this stage. We are seeing right now the instability happening in Indonesia, Thailand. So Malaysia has gone past that, and actually we are seeing the government proactively implementing all the pro-growth policies. So within emerging market, we like the Asian countries, ASEAN, China as well.
So ASEAN and China we got here. So here we have another question whereby today we have two global funds that uses very different strategies. One is investing in low vol, steady and durable business leaders in their respective industries, while the other actually using a mixture of bonds and equities as well as other derivatives aiming to provide regular income. So as an investor, I mean, as well as all of you sitting here, the question that I will have is, what kind of style should I go for? Maybe I can start with Mr. Jeremy first, yeah.
So style in terms of growth,
Investing
value.
style, yeah.
So it's interesting. I think if I think about 2026 and what styles will perform well, I think you have to dissect the globe. And there was a chart I showed earlier that just showed the outperformance of value when you look at markets outside of the US. So Japan, Europe, these are markets that are trading at much lower PEs, but also don't have the same level of exponential growth in their companies, as historically has been seen by US businesses, and especially the dominance of technology within that index. And so if I were to think about styles, I would think about it more from a regional perspective. And I think within the US, we're going to continue to see AI technology dominate headlines and be, a meaningful contribution to overall returns. Outside of the US, I think there's a much wider opportunity set where value as a factor and quality in particular can add incremental value. And so I sort of dissect it in that type of framework when I think about the world.
Yeah, so how about Mr. David here?
Honestly speaking, I think levels are not important, right? Because over the years, we keep talking about value, growth or value for this year, right? To me, I think the levels doesn't matter. What matter is that the valuations and diversification. So I just want to joke, right? I always joke this, If you look at value index, and I just had a look at this index, Russell Value Index. Alphabet and Amazon are in the value index. So it's like calling black or white, right? So it doesn't matter, ladies and gentlemen, my honest opinion. I think valuation and diversification. And when it comes to, let's say when you ask style, right? I'll put it in this way. You still want to have growth in your portfolio. You still want growth because growth, you want your money to grow over time. That's growth. But my contention that I highlighted during my presentation just now was, my only issue is that the market are priced pretty much, near perfection. So any earning miss will be a risk. So that's my only contention. So diversify, go for growth for your portfolio. And the other three is something that sometimes we tend to forget. We need cyclical in our portfolio. Cyclical is like your energy industry, your material, your industrial. So when you talk about economy of a country is doing well, typically you see energy sector, industrial, or even consumer do well, right? So this is the next sector, cyclical. And last but not least, defensive. I think you highlighted about healthcare. We love healthcare as a sector. And the thing about healthcare is the stability of the industry. Rain or shine, the need for healthcare would not change. So these are the things when it comes to defensive, cyclical. Cyclical is economy do better, cyclical do better. Defensive, anything were to happen to economy or market, typically you see defensive will hold up a lot more better. So my apologies, my direct answer question would be, I think growth or value doesn't matter, but valuation, be cautious of evaluation of the investment that you own in your portfolio. Always talk to your advisor about, am I overpaying for this kind of market, this sector? Always ask that kind of question to your advisor. And second thing is, keep it diversified. I think from that perspective, I think our investors should do well in 2026.
I think Mr. David here gave a really good summary. As an investor, we always look things from a portfolio perspective. So inside a portfolio, we want we would want the growth portion to give us alpha when the market is good. But we don't want to all in because we want to have some of it in defensive value that gives us that low vol safetiness when there's volatility in the market. But at the same time, we also have another thing that gives us regular steady income that allows us to have extra cash to support our daily needs and everything. So it's more from a portfolio perspective, it's good to have all. So, and then the next question that we have here is actually directing to Mr. Christopher as to, within Malaysia, your top 3 sectors. Maybe you can elaborate a little bit.
Yeah. So I think for Malaysia, our top 3 sectors for this year will include banking, infrastructure and construction, and also the renewable energy place. Infrastructure and construction, if we consider one, we also like the consumer and tourism place for the Visit Malaysia 2026 year.
Okay, thank you. So before we end, one very final question for all the speakers here today is that what is the biggest risk that you think that will happen in 2026? And may I start with Mr. Lu first?
I'll go back to your first question. It would be a geopolitical risk for me.
Okay, that's a pretty way to summarize it. And secondly, for Mr. Christopher, for Malaysian markets, what do you think is the most biggest risk there? in 2026?
Yeah, I think, yeah, although this is about Malaysia, but I think globally the biggest risk is if there's a slowdown in the AI development, because that could, create some correction in the high value AI stocks. And also in Malaysia, because we do have some exposure to the data center, build out, and also the tech space. Some of our tech companies do export into the supply chain. So that is also one risk affecting Malaysia. But I think the good thing about Malaysia is Malaysia tends to be a more defensive market. So when the rest of the world, experience a big correction, the correction in Malaysia tends to be a bit less, given our low beta nature. But I think risk of AI slowdown or a hiccup in terms of the technological advancement of AI still remains a risk for global markets.
Yeah, so AI risks and geopolitical risks are the top risks that we should take a look after in 2026. So when it comes to two global fund managers here, can I ask whether what is your top picks in terms of regions or countries for 2026?
So my colleagues on stage will like this. Europe is definitely an area that we like, and I think I've discussed sort of the key drivers for a top-down view on Europe. The other place is Japan. So again, looking for countries where there isn't conflicting monetary and fiscal policy, I think is really important. And there's structural reforms happening, and valuations are still compelling, even though we mentioned 40-year highs in Japan in particular, but the setup I think is excellent there. And so again, when you think about fiscal stimulus, coming through and driving economic growth, if you think about normalization of monetary policy, they've had 2 decades of deflation. And 75 basis points base rates is nothing relative to the rest of the world. So still very accommodative policy. And then thirdly, if you think about the corporate reforms that are happening, the greater focus on shareholder value, on return on capital, that's driving significant profitability. And we saw that in 2025, and that has a long runway for growth. And so if I were to think outside of Europe, countries, EM is definitely part of it, but Japan, I think, sits in a really unique position.
So Europe and Japan. So for Mr. David, I have a slightly different questions for you for the last one. So for 2026, which asset class will be performing? Fixed income, equities, derivatives, commodities. What would be your pick?
Win, I think you know my answer already. But anyway, as a multi-asset income manager, we like all three.
Oh, okay.
Equities, bonds. Equities because equities grow your money, right? If you look at over the long term, if you buy a good quality company, over time, equities grow your money. But bonds, we cannot forget at all about bonds. Bonds at the current market opportunity, the yields are still compelling. Just now, I think the earlier questions about which market do we like. So we like any markets that give good yield. From US, you are getting about income from bonds, anything between 4% from treasury to a high of 9% of high yield. And then stretching into outside US, we are able to find a good equity company in Europe. They pays a very decent dividend yield, right? And you'll be surprised. Like, I think the last time I saw Nestle Switzerland pay a higher yield than the Nestle Malaysia stock. So I think we have to be open outside Malaysia, and we can get any income opportunities in from US, Europe, and this part of the world. So coming back to your question, Erwin, in terms of asset class, we like all both, simply because one, we have to tread carefully in terms of portfolio in 2026. Markets have done really well, no doubt. I think in 2025, the way to go forward in 2026, be nimble, diversified, be opportunistic every time there's something were to happen to the market so that you can take advantage in the event of any market shocks. The beauty about multi-asset income investor is that anything happen to market, my portfolio are being supplemented by regular income as often as money basis. So while NAV can be under pressure during market shocks, nothing beats like seeing income or cash, right, flowing through into your bank accounts as often as monthly basis. So again, regular income stream. Don't forget about growth and be open to markets around the world. And of course, coming back to your question, we like all asset class simply because I know it sounds cliche, right? But that's the truth. Yields from bonds are still compelling. Yields from equities are still compelling. Yields from hybrid securities are still very good. The more volatile the market is, my manager can go into a structured equity linked shares that can pay about 8 to 10%. So, we, as an income investor, we love the current market backdrop.
So
Hopefully that
what
answer.
would be your recommended allocation? As in how many percent in equities, how many percent in fixed income?
Oh yeah. I think the answer to that question is how many percent is don't be too rigid, right? Remember my earlier point about flexibility, right? But I can share what we do from our end. So what my team do was we allocate between equities and bonds. We don't do it 50-50. We don't do it 60-40 either. So what we do is we can go to a high of 75%, can be equity or bonds. So like 10 years ago when bond yield are so low, we have to do equities to stretch income. So we can go high 75%. And then from the low, we can go is about not really zero, lah, right? Because that doesn't justify diversification, right? We go to a low of 25%. That's what we do from our end in Franklin Templeton. And not only that, the asset ratio makes also important, but don't forget dynamically. So if interest rates now is high, buy a bit more bonds, anchor your portfolio, beat the cost of living in Malaysia. And then the other elements of your portfolio, a bit more growth oriented. But be careful, among the growth, you have to go selective in terms of the growth sector or investment that you go for. Yeah, I think that's my honest advice.
You heard from the experts here, so I hope that this session, this panel session here, give you a good takeaway, as in what and where to invest, where are the investment opportunities, and what asset class is more preferred. So as we end here today, can I trouble to pull up the Slido voting that we had just now? Yeah. Yep. So once again, thank you.